Hi, Greg Weldon here with another episode of Money, Markets, and New Age Investing. And I tell you, every time I start to do a podcast, I realize there's just more and more information that I want to share with you. Today, we're going to call this podcast episode number 14, One Thing Leads to Another. Old song from The Fix, if you remember the 1980s, very popular song. You've probably all heard of it. But for now, and I'm going to tie this all together at the end in that theme. But for now, I'm going to go back to a theme we've used before, which is back to the future. Back to the theme, back to the future. And we have various time frames that we want to travel back in time and look at the similarities between what's happening now and what happened then. And maybe this will give us some clues and some tells as to what might happen next. And that's what I love to do. And frankly, when you kind of look around, you don't see too many people in the business now, being professional traders or macro researchers like as am I, that were around in 1985 when the G7 got together in New York City and signed the Plaza Accord, which they decided to devalue the dollar. Not many people around today as professionals were around in 1987 when bond yields skyrocketed and the stock market crashed as a result, ultimately. A lot of similarities to 87. We're going to go back to 87 in a few minutes. But 1997, all right, emerging markets had been huge in the 90s. Tech and emerging markets. Internet, remember, there was no such thing as the internet or email or any of this stuff. It was all paper when I started. I was starting the Florida Exchange. Everything was done on a piece of paper. I mean, imagine how archaic that is compared to what we see now, right? But you had the tech, the tech movement, and you had emerging markets. They were called the Asian Tigers, all right? Thailand, Malaysia, Indonesia, these countries, kind of peripheral countries that all of a sudden were these mini economic juggernauts because of exports. They were export reliant. A place like Singapore still relies on exports for like 100% of their GDP growth. It really is true. So in that context, I remember I was working at a commodity corporation in Princeton, New Jersey. If you've read the book, and if you haven't, I highly recommend you do, Market Wizards by Jack Schwager, who I worked with at Proof for a long time, a colleague of mine. And within that book, they talked about Commodity Corporation and all the great traders that came out of Commodity Corporation, a place you don't even know, never heard of probably, most people now. But at that time, it really was a think tank of trading. Like, what's the optimum decision all the time based on your, highest EV going forward? And I was one of the top traders in one of their programs at Commodity Corp. I was up 62% return after fees, in 2 years that I was there. And one of our big positions was being short the emerging market currencies in 1997. I'll never forget the day that I came across ISI, which was a research product. Ed Hyman, one of the greats in this industry, first ballot Hall of Famer, and showing that the exports in Malaysia and Thailand, along with Indonesia, had started to decline year over year. It was the first month of year-over-year decline in exports, like in the history of the Asian Tigers, which dated back to the late 80s. So we're not talking about, decades. But nonetheless, these had been booming export times for these countries that came to a sudden screeching halt, and you saw exports start to decline year over year. And it was like one of these things like, well, they need to maintain, and it's a competitive dynamic. It was the first kind of competitive currency dynamic in emerging markets, at least, that I had seen. And we got short the Malaysian ringgit and the Thai baht, and we made a ton of money, really did. And you have a similar situation here now, where, again, tech and emerging markets are a big deal. Tech, because again, it's kind of like the engine of economic growth. Less so in the 90s because it really was about Asian tigers and exports and global trade, and it was globalization too. All right. Now the 90s tech bubble that led to the tech bubble crash is kind of an AI bubble almost. And, I asked myself, you're going to let AI kind of take over, making macro decisions, trading, economics, markets. Because if AI is truly self-learning, AI will very quickly learn that a lot of this is a house of cards. And what does the AI do? Collapse the whole thing to get back to a place where you can have organic growth without having to print trillions of dollars, every year, without having the federal government that borrows $1 billion an hour just to stay open? It kind of is a joke when you think about it. But in that context, we have an emerging market crisis going on right now. And it seems to me that I listen to financial television for the few minutes a day I can stand it. The bullish theme that everyone comes on there because every guest is a stock market guy, and the channels the ratings go up when the stock market goes up, so on and so forth. So this vested interest in being bullish on TV is mind blowing to me. All right, even to the degree that I know that some of the people on there are smarter than they sound, because they're telling you something that they know is not true, just to kind of boost their own book, because all these people are, have a vested interest in watching stocks go higher. So I don't hear anything about this emerging market currency crisis that is currently taking place right in front of us. All right. Let's take a place like Malaysia, because it goes back to 1997. This is our Back to the Future tie. All right. Year over year exports in Malaysia are down 6 months in a row. And I haven't seen that since, like 1997. All right. And when we see this year-over-year decline, it is in every sector, industry within Malaysia. All right. The agricultural sector, exports down 27%. Palm oil, one of their big exports, down 32%. Mining exports down 23%. Within that context, tin, a big component of their mining, down 22% exports of tin, down 23% in terms of exports of rubber. Crude oil, down 23%. Not only that, but it's also in terms of trading partners. Malaysian exports to Singapore, down 19%. To China, down 20%. To the U.S., down 10%. And to the EU, down 5%. And all of a sudden, the ringgit is on the verge of making a new all-time low below the 1997 low, which was a massive blow-up in the currency. All right. So we go to Asia. Let's take somewhere in Eastern Europe. All right. We're going to be kind of geographical about this. Georgia. All right, a country on the southern border of Russia, former Soviet Republic, connected to Turkey. All right. Now I can tell you that Georgia has been an extremely resilient economy during the times when it's been an economy, so to speak, not a communist country. And you had only 2 periods where you had a quarterly decline in industrial production. Okay, one during a pandemic and one during 2008-2009 crisis. But only one quarter. You have not ever, in the last 15 years that they've tracked this data in Georgia, had a back-to-back quarterly decline in industrial production until now. And not only that, but industrial production down 9.8% year over year in the most recently reported data. It was reported like 2 weeks ago. And it's the deepest decline in their industrial output in the history of the country as a modern economic, participant, so to speak. This is a big problem, all right? Exports have been running double-digit growth right up to July when it was up 23.1%, all right? Down 9.8% in August. Rather in September. That's versus down 2.7% in August. So these numbers are really, really bad. This is actually quarterly, I should say. So it was the second quarter was down 9.8%, first quarter down 2.7%, and prior to that was up 23.1%. All right. Here's the other part of this. All right. Georgia's CPI year-over-year rate of inflation is 0.9%. It's not even 1%. And yet they had an 11% interest rate against a 1% inflation rate. Think of how punitive that is from a monetary conditions perspective. It's hugely punitive to the point of wrecking the economy, which is exactly what's happening. Okay. And in that context, the Georgian central bank has cut rates 3 times in a row. Okay. And the lari, L-A-R-I is their currency, has gotten whacked. All right. Now, Georgia, not a big country, kind of doesn't matter. I might say that a country like Angola is kind of interesting. You'd say, scoff and say, who cares? We're in Africa now. Okay, we moved from Asia to Eastern Europe, now down to Africa. Who cares about Angola? Well, Angola and Nigeria both have currencies that are at or have been at record lows. All right, Angola just devalued their currency in a huge way. All right, these are 2 countries that between them have capacity to produce oil, OPEC membership in their history, that is 4.5 million barrels a day, which would more than make up for the supply shortage we have right now that's driving crude oil prices higher because Saudi Arabia and Russia cut output. All right. But no, they can't do that. They're producing less than 1 million barrels a day. Nigeria, I think last I saw was somewhere around 1.6 versus 2.5. Maybe it was even lower. Maybe it was 1.3 versus 2.5, in their capacity. So this is a place where it could produce a lot more oil, but they can't because the currency's gotten smoked and because the central bank there has been printing money like crazy. Money growth's at a new high in Angola, okay? And from that perspective, you can see that the year-over-year rate of money growth is 34% year-over-year. I mean, that's huge. The inflation rate, 13.5, it's up from 10. And here's where the kicker is. They just dropped fuel subsidies in Angola, okay? A country that produces their own oil, then produces gasoline and gives it to the citizens for a cheaper price than they sell it, on the open market. They ended that process because they can't afford to do it anymore fiscally. All of a sudden, inflation was up 1% 3 months ago, 1.4 4 months ago, 1.4 3 months ago, 1.6 last month, and now 2% for the month. Think about that. That's almost 6 percentage points just in monthly gains on a 34% year-over-year increase in money supply. So what happens to the Kwanza? The Kwanza it's gotten smoked. I mean, dollar Kwanza was at 97 Kwanza per dollar in 2014. Today, it's 833. More than eightfold depreciation in the purchasing power of the domestic currency at a time when inflation is running 13%. Think about the hardships for the average people living in Angola, in Georgia, in Malaysia. All right. The dollar Kwanza since 2014 is up 754%, and that's small compared to some of the other currency moves that we see. Nigerian Naira, also big move. The Zambian Kwacha, also a big move. All right, the Uzbekistan Som, the Kazakhstan Tenge, the Georgian Lari, the Azerbaijan Manat, the Turkish Lira. Well, they say all of those countries really don't matter. Ghana, Bahrain, Oman, Kyrgyzstan, Pakistan, Vietnam, and Argentina have all had issues here where their currencies are in the crossfire. Say, okay, we don't care about these countries. Do you care about Brazil? Do we think that Brazil's a major country? Yeah, it sure is. You realize Brazil cut interest rates twice in a row now, just cut them just last week. Their exports are now falling. All right. And in that context, all right, the CPI is 4.6 against an interest rate of 12.75. Their interest rate is prohibitively tight, which is kind of crushing the economy. All right. But what's really interesting to me is what the COPOM, which is the monetary committee of the Brazilian Central Bank, said when they cut the Selic rate just this past week. All right. And it's really interesting because these are words that Jerome Powell might want to store in the back of his head for later use himself. That a re-anchoring of inflation expectations demands serenity and moderation in the conduct of monetary policy. Think about that for a second. Let me repeat that. Let's just contemplate that as I say it. A re-anchoring of inflation expectations. In other words, inflation is lower. We expect it to be lower. Certainly the Fed has said they expect it to be lower. The ECB has said they expect it to be lower. Every central bank in the world and every investor in the world seems to believe inflation is going to move lower. So a re-anchoring of those expectations to the downside demands, quote unquote, demands serenity and moderation in the conduct of monetary policy. Serenity and moderation. I just picture Frank Costanza from the show Seinfeld, serenity now, serenity now. And this is kind of like, don't we need some serenity among central banks who keep raising rates, especially the Fed, with the hawkish rhetoric that I think is very specific, and we're going to talk about that in a minute. But then the Brazilian central bank said something else that really just jaw-dropping to me. Quote unquote, taken right from their monetary statement. The committee noted higher long-term interest rates in the U.S. and the prospect for lower growth in China, both of which require greater attention from emerging economies. Damn straight they do. You know why? Because emerging economies are getting crushed. You know why? Because the Fed is so hawkish here. You know why? Because of their whole dynamic around Paul Volcker and Jerome Powell, hero worship of Paul Volcker. And I'm not mocking Jerome Powell. I think he's done a great job and he's done everything he said he's going to do. And he's made some mistakes. But who would want this job? It's the hardest job in the world. Okay, unless you're Nick Wallenda and can walk across a tightrope over Niagara Falls, you're not going to be successful at this job walking across a tightrope for your entire career. You're going to stumble. All right. But I think it's interesting that the Central Bank of Brazil, who is cutting interest rates now, who has really high positive real interest rates, which are punitive for the economy. And so many places like this. I just listed them all. And there's more, way more. All right, I could throw India into the mix right away. I mean, Indian rupees had near record low. And that's a hell of a lot different than talking about a place like Ghana when you talk about how many people live in India and how many people are suffering because of the macroeconomic dynamic. But the fact that the Brazilian central bank is noticing higher interest rates in the U.S. and less growth in China, what are they noting? They're noting stagflation. They're noting some sense of at least central banks that want to stimulate stagflation. And we'll talk more about that in a minute. But in this context, this whole thing then from 97 actually takes me back to 1985. So Back to the Future number 3, we go back to 1985. Or Back to the Future number 2, we go back to 1985. I'm ahead of myself already. All right. What happened in 1985? I'll never forget. I was working on the Florida Commodities Exchange in the World Trade Center. I lived in Hackensack, New Jersey. Took the train every day. It took about half an hour on the train. And I just remember waking up for that morning to get to work. And I had the little Quotex machine, and the news comes up. And the G7 has gathered at the Plaza Hotel in New York City over the weekend and decided to devalue the dollar. That the strength of the dollar was hurting other economies, particularly in Europe, but also in emerging markets, and that they needed to move the dollar lower to stimulate global growth. This is kind of where we're going. It is. I think that, as the dollar moves higher, and I think it goes higher first, this has put so much stress on emerging market economies, puts so much stress on commodity prices, which is what the Fed wants, and it puts stress on the U.S. stock market. And we're going to talk about that more in a minute, too. But this reminds me very much of that, in potential of what could happen next. What's the next phase after we go through the next phase? What's the next phase? What's the second next phase? Okay. And what happened then? Stocks exploded into 1987. And we could see a situation where you get kind of a big meltdown in stocks. The Fed returns to the party, and then stocks, start trading back to the upside. But the question then becomes, are stocks out appreciating inflation and the dynamic around the debasement of the purchasing power of your money? And I don't think it's going to. So that's where it becomes a problem. Where stock market's going higher, don't create a wealth effect. Just like in Argentina, stock market makes a new high every month. Do you think the people have a higher standard of living there? No. All of this comes down to standard of living. And certainly in emerging market economies, the standard of living has gotten crushed lately. So that sets up something down the road. And what makes the 80s different, of course, all these differences. I'm not saying this, there's like these really, that everything is the same. Of course, not everything's the same. Of course, there's huge differences. But one of the biggest differences, and this ties into another Back to the Future we're going to do in a second, is that in the 1980s, you had no debt as a country. I mean, the fiscal deficit was nothing. The public debt was virtually nothing. And Reagan was able to use that, to basically fight a Cold War against Russia, outspend them on weapons, and take the economy into boom times. You don't have that option now. It's not there. The dollar is really going to be the only way, especially if you feel you can't cut interest rate because inflation is still high. Well, then you use the interest rate dynamic against inflation to create a higher dollar, which sparks the disinflation that you want to see. Problem is, you don't have disinflation in the stock market yet, or in gold, or in energy prices. So that's a problem. We're going to get to that in a second. But that takes us to our Back to the Future of 1987. Because it's really the relationship between bonds and stocks that has gotten so out of whack here that it is eye-opening and jaw-dropping. All right. When I talk about the overlay between the market now and the market in 87, certainly there's a lot of differences. But the stock market overlay to the Dow, because it has more history versus the S&P, all right, since June of 2022, it is lockstep. I mean, and what's the biggest similarities are? The attitude, all right, and the complacency, all right? The attitude around bonds that, stock market's just not paying attention or is ignoring it, or I don't even know, thinking it's immune from a rise in bond markets. Well, the stock market thought that in 87 too, until it wasn't. Until all of a sudden in August and September, bond yields broke out again and rose again with big one-day moves like we've just seen. You've had a mini global meltdown in bond markets here. That's very similar to what we saw in 87 that led to a major decline in the stock market. The pandemic has kind of messed up that overlay, going back any further. But I'm telling you right now, it is right on since June of 2022. And it is right into the zone where you're facing trouble here. And the fact that the calendar of the time of year fits perfectly too is not lost on me, that's for sure. More so is the degree to which the stock bond ratio has gotten completely out of whack. So far out of whack. We can look at this in a number of ways. If we look at bond yields divided by the stock market, all right, and we kind of look at how that plays off against the stock market itself, what we see is, through the 90s, the 80s, and the 90s, you had organic growth in stocks and bonds that really didn't move much, all right? Even through into 2000 and the tech bubble crash, it wasn't like all of a sudden they printed all this money. QE didn't start till 2009, which of course I predicted in my book in 2006. All right. But to the degree that QE then started the relationship between the stock bond ratio and stocks to be very tight, because from then on, the stock market was relying on ever increasing reliance. And you could see the stages, all right, of this on ever lower bond yields, and it had a 40-year trend towards lower bond yields and lower inflation that was dominant. All right. We have just started doing another free service in addition to the podcast. It's called In a Macro Market Minute. It is literally a 60-second video every day for free on YouTube. And I have charts on that show you these relationships that I've just mentioned, I'm going to mention. All right. You might want to check out September 26th. September 27th and September 28th. Those 3 days in a row, the charts are worth just taking 3 minutes to look at them, I'm telling you. All right. So in a macro market minute, it is on my YouTube channel, which is /user/Gregory Weldon, one word, capital G, capital W, Gregory Weldon. All right. So go check those charts out and sign up on YouTube to get that every day for free. But what it shows us is that we rely upon lower bond yields. And when the pandemic hit and we relied on $8 trillion of newly printed money to get ourselves out of it, the relationship became exact until the Fed started raising rates. And all of a sudden, of course, the bond-adjusted stock market declined because bond yields are going up, all right? And at the same time, the stock market hasn't moved. And if you use that ratio and that correlation and that overlay, which is, nothing's 100%. Nothing is going to be the only thing that matters. But just as a guide, it's telling you the stock market risk here is the same as it was in 1987. Mathematically, the same. And that means you have a 50% downside risk in stocks. Now, do I think the market's going down 50%? It might. I think it's not necessarily going to crash, although it might. But I think this would be a dynamic where bond yields would eventually move lower when stocks get really weak. So you'd have some meeting in the middle there. So thinking that a 30 to 35% correction in stocks, is just not going to happen would be foolhardy to think that. It can happen, and I think it will, and I think we're on the verge of seeing it. Okay. In the same situation, and it kind of the way that you look at that overlay, that's where it kind of comes into my other theme of the Wile E. Coyote market. Because it's like, the stock market's run off the cliff and the bond market's just standing there looking at it, and the stock market has yet to look down, And Wile E. Coyote, when he looks down, he knows what's coming next. And I feel that's kind of an applicable analogy, I should say, with the stock market. All right. But what's happening within emerging markets then ties in. Why? Because these countries are kind of saying we're going to ease here to protect the economy. And there's a lot more to it, but let's kind of simplify it as much as we can. And we could argue at this point that they're basically saying we're going to acquiesce to higher inflation to protect the economy. And I think this is somewhere you're going to go everywhere. The Fed will raise, they will create an inflation target band eventually. And it will be, say, 2 to 3% or 1.5 to 2.5 or 1 to 3. I don't know what it'll be, but it'll be acquiescing to higher inflation because the 40-year downtrend is over and you're now going to work to higher highs and higher lows. Why? Because of $35 trillion in debt and borrowing $2 trillion a year and borrowing $1 billion an hour to keep the government open. That changes everything when you now have more money chasing fewer goods, the definition of inflation. Okay. When we talk about the Dow Jones relative to the 10-year yield, let's take the Dow and multiply it by the 10-year yield. And let's see what happens. Wow, this is really interesting because the peaks in the tech bubble and the peak before the global financial crisis was almost exactly the same at what would be a yield-adjusted value for the Dow of 75,000. And you can go in a micro market minute and see these charts. Right now, it's more than double that. It's at 171,250. I mean, it's twice as high and out of whack as it was before the tech bubble crash or the global financial crisis. We can also trace this back to, yes, September 87, May of 1990, and April of 1998 before those other crises periods. It's not a coincidence, man. This market is very, very vulnerable. All right, let's do one more. Let's take the 30-year bond yield against gold. All right, and man, this doesn't take us back to 1979, which is going to be our final Back to the Future. We're transitioning here now from the 80s back to the 70s because gold versus the same dynamic. Gold multiplied by the bond yield. Right now, gold would be $8,700 an ounce. The high on an adjusted basis in 1979 was $8,140. You're higher. It was actually 1981, and that was before the 10-year took off and made a new all-time high at 15.8 in 1981. The pandemic low was 1050. You're at 8,700 now. That's a 730% increase. When you add the dollar to the interest rate dynamic, monetary conditions are tightening like crazy. And that gets us to our last Back to the Future, which is 1979, 78, 79. Paul Volcker, his first speech before Congress, first what they call the Humphrey Hawkins testimony, was very specific in his language. And Powell uses the same words, the same phrases, the same language. It's the Jerome Powell is using the Paul Volcker game plan. And this means paying to the economy. It means higher unemployment. He's told us this. I'll tell you what, for all of he's made mistakes, but Jerome Powell has told us exactly what he's going to do, and then he does it. All right, and he doesn't hold back. All right, did he wait too long to tighten? And did he use the word transitory for too long? 100%. We're all over him for that. Is he staying too long now? Well, you can make a case that he is, but you can also make a case that he isn't. It remains to be seen. The problem is that Paul Volcker was very specific to say, I don't want to see a credit contraction. Jerome Powell has said we might see a credit contraction, and that's part of what we need. And it is. It's absolutely part of what we need. Okay? But you're playing with fire while your body's doused with gasoline here. It really is. Because it's not, a credit thing, this whole 40-year bubble is built on credit. You want to prick the bubble and not let the balloon deflate. That's a really hard thing to do. It really is. And the big difference here is you get a credit decline here versus 78, 79 and Paul Volcker when he raised interest rates to defeat inflation. Again, no debt back then. You could expand fiscally to your heart's content back then. You can't do that now. So I started saying in a piece on February 12th, 7 months ago, almost to the day, just over 7 months ago, 7.5 months ago, that the Fed wants to see disinflation in the stock market, in housing, and in gold before they're going to turn. Now, we've seen disinflation in mortgages. We've seen disinflation in home sales. We've seen disinflation, which is breaking down, threatening a 30-year uptrend. All right, we've seen disinflation in inflation. We have seen disinflation in home building. We've seen disinflation to some degree, at least in growth and credit. We've seen outright deflation in retail sales on a real basis because when you take price adjustments and apply it to the resale sales data, which is not price adjusted, you've been negative year over year for 12 months in a row. Labor market's showing signs now of some disinflation, but they want disinflation in stocks. I've been convinced of this since February, and when they get it, that's when maybe they'll turn. They're going to keep pushing until something breaks, and that something is the stock market. And I've said this so many times, and I said this on the podcast. It's difficult for the Fed to justify turning towards an easy policy or turning away from tightening when the stock market is almost very close to record highs and gold's at $2,000 an ounce. Why do you think there's a triple top with all kinds of downside reversals from $2,000 in gold? Someone's stepping on it. All right. Now, what's interesting here is I don't really think the Fed doesn't want to hike again. And I think that I think they're going to pause. It doesn't mean it won't hike again. But I think they're going to pause. But I think that Powell would love to see the dollar do the dirty work for him. Okay, the dollar has broken out. It has broken out. All right, it's gotten above 105. All right, the next point of resistance is 121. That's a huge move. 15% move. 15% move, and the dollar will crush emerging market economies, will crush our economy, will crush the stock market, because the dollar leads stocks every time. A weaker dollar is bullish for stocks. A stronger dollar is bearish for stocks. It's that simple. Go to In a Macro Market Minute on YouTube and see the charts. You will see the overlay, and you will see that the dollar relationship right now is suggesting there is at least 400 points of downside on the S&P 500 in immediate risk because of dollar strength. Right? What's more important here is the dollar's breaking out versus gold. And that is a sign of tightening monetary conditions. And I think that this is really bad for stocks. It's really bad for the whole overall commodity. Certainly bad for gold. Gold is broken 1884. Now, I still think gold goes down if the stock market goes down, but it goes down by less. And then you'll have a Back to the Future 2008-9 scenario where gold stops going down and turns and just runs to the upside the second the Fed hits the button again to start printing money, and they will. All right, but for now, that could be really bad for gold. The UUP is the dollar upside ETF that's been in our portfolio for our New Age investing portfolio playbook, which you get a copy of if you want. Just email me. The last one was really interesting. It has all these charts and then some. It's 62 pages long. All right, but in this context, all right, you still have energy out there. All right, so what if you have the base effect coming in, not only in crude oil, but in the dollar too, because the dollar was at new highs this time last year, and that's about to turn. And all of a sudden, you're going to see crude oil on a year-over-year basis, particularly in dollar terms, like really accelerating, even nominally. And you have such a shortage in crude oil right now that the 12-month swap rate is $11, meaning that people are willing to pay $11 more per barrel for crude to get it now than they would in 12 months from now. And that's designed to bring product to the market to meet demand, which is higher than supply. So what happens if CPI, food is still very high everywhere. This is an energy dynamic. Energy is the only thing down, and that's brought CPI down. It's been disinflation thanks to deflation in energy versus a year ago. That's it. Now energy is rising again. Now the base effect is going to kick in because you had a big decline in energy last year at this time, and holy mackerel. There's a very good chance that inflation could get back to 5% on CPI, maybe even 6%. What if it gets to 5.5%? Well, all of a sudden, the Fed is no longer restrictive at a 5.5% Fed funds rate because it's compared to inflation. Now, maybe PCE would be different, so on and so forth. The point is that they want to be restrictive, and if inflation rises, they're going to have to hike more to stay restrictive, to keep policy the same as it is now. If inflation goes to 5.5%, they got to go to 7%. I wrote this before Jamie Dimon said it, and he's all over the news saying it, and I don't think this happens, but it very well could. I know inflation is going to rise again. The question is, will the Fed stick with their hawkishness? Because the next round of inflation is going to crush the economy because there's no savings. Wage inflation is non-existent on a real basis, and it's just, again, all of this comes back to kind of being a house of cards. And if it was AI telling us what to trade and what to do economically, it would say blow up the whole thing and start over again. To whatever extent, there's a lot of people out there to say they're going to do that, and they very well may be right. We'll see. But bottom line is one thing leads to another, and that's why we're here. And I did this piece on Thursday of this past week. One thing leads to another. I'm just going to read you the very first page. All right. The big picture macro market has morphed into a global bond market meltdown, and one thing leads to another. Irresponsible money printing and deficit spending leads to inflation. Inflation leads to an overtly and unrelentingly hawkish Fed, which leads to a vaporization of the forward market expectations for rate cuts next year, which has happened. I've talked about that all year. Rising bond yields and a higher dollar, which leads to tightening monetary conditions, a credit contraction, selling of securities of banks, which we've already seen, emerging market currencies plummeting to new lows, we've seen, a breakdown in gold, we've seen, and bearish rumblings in the stock market, we've seen, which leads to all of this, a breakdown in stocks, and a global recession, because let's not forget, things are much worse around the world than they are here in the U.S., and we're very U.S.-centric, all right? And what does that lead to? Well, one thing leads to another, eventually leads to more money printing and then an explosive rally in gold, energy, food, commodities. The entire cycle repeats, and the standard of living begins to reverse its own 40-year credit-fueled bull market that's been facilitated by officialdom since 1971. It doesn't matter what the end game is, inflation or deflation-wise. There's one thing that is certain, at least in the near to medium term: a lower standard of living. Greg Weldon, thank you for listening. Join us next time for Money, Markets, and New Age Investing.